With NAFTA negotiations set to begin this summer, Canada may start thinking about taking some of our economic eggs out of the U.S. basket. But where should we put them? Economist and director of Barclays, Barrick Gold Chevron, Dambisa Moyo tells us, with growing de-globalization sentiment around the world, we need to seriously think about diversifying our trade agreements.
I think many countries right now are quite concerned about what a deglobalizing world looks like, particularly as trade tariffs and quotas have been increasing over the last decade. And we've only now started to see a small uptick in the increase in trade. We've seen the European Union, specifically President Macron, newly elected in France, talk specifically about how Europe needs to be much more internally focused. And so I would recommend that Canada think much more broadly about how it's going to be part of the global economy and not just focus on the United States. Obviously, a big chunk of the United States trade, as well as Canada's trade, is along the border, and so there's a natural relationship there. But Canada is an exporter of natural resources, but also a very developed economy in many respects, and therefore I think there are many other opportunities for them to engage with places like the United Kingdom, across Asia in particular, but also in the broader emerging markets where we are seeing global growth increase.
You point out that when it comes to globalization, that's actually really a difficult thing to do in practice, and myopia plays a role in that. Is that a wink and a nudge to Donald Trump's sort of America first, zero-sum game approach to trade?
Well, I think that it's very clear that the policies, both in terms of economics and politics, have been very focused on short-termism. The United States has elections every 2 years. We have seen short-termism in business with the terms of CEOs shrinking quite considerably, but also we know that in terms of investment scales, a lot more companies now are focused on passing back money in terms of dividends as opposed to reinvestment because of real concerns about what the longer-term outlook for global growth looks like. I think that President Trump is really reflecting a sentiment that's not just United States focused. I was just in London yesterday, and people in Britain are obviously, in the post-Brexit era, are really quite concerned about a world in which they feel like there are no benefits for British citizens, and they want to prioritize, I guess in your words would be much more of a making Britain first again. So I think that is a sentiment that's just not in the United States, but quite global now.
What of the trade policies that the West makes, you warn that there's a destabilizing effect elsewhere in the world?
Yes, absolutely. I mean, global growth and the idea of globalization, so if we think about trade, cross-border capital flows, the movement of people, those are three key pillars which were defining pillars of the globalization agenda of the Washington Consensus back in the late 80s and 1990s. Many emerging markets, where 90% of the world's population lives today, relied on that backdrop to form a lot of the policies that they engaged in terms of trade, in terms of cross-border capital movements, and in terms of the movement of people. And so now they're looking around and seeing that actually the world is becoming much more deglobalized, much more siloed, much more inward-looking, and they have to now readjust the policies that they've relied upon for the last 30 years. I think it's a considerable effect on whether countries can accept or depend on foreign monies for investment and for infrastructure build-out in emerging markets, but also many of these countries are very subsistence-based or heavily based on the export of commodities. And in a world where that regime is becoming quite challenged, it means that trade revenues for these emerging markets will be quite challenged as well.
And what's the knock-on effect to that problem?
Obviously, global growth going down. We've already seen that. For many emerging markets, we need to grow by 7% per year in order to double per capita incomes in one generation. Global growth, but specifically emerging market growth, is significantly below that 7%. Russia, South Africa, Brazil, just coming out of recessions, are growing at around 1%. The larger economies like India and China are growing. We just saw the IMF revise China to 6.7. India is probably around 6.5%, but still below the 7% number that we need.
This protectionism trend that we're seeing, you say that's bad for the banks. How?
Well, it's not. The banks are simply tools for delivering capital from investors, from savers to investors. So I think it's a bit short-sighted to think about the banks. So ultimately, the banks will put money to work in a place where they think that they can generate revenues. In a world where there is not economic growth, that is the real concern. Where are we going to put money where you can generate returns for the pensioners who are the savers who are looking to get higher returns? And I think that the broader sentiment, if you look at the S&P 500 and many other stock exchanges, we are seeing is that CEOs and companies are deciding to give back money in the form of dividends rather than reinvest the money because they are worried about long-term growth prospects.
That sounds though like they're only thinking on short-term basis, on a quarterly basis, a stock price performance basis, as opposed to a long-tail solution for enhancing growth.
Well, partly, yes. I mean, they're forced to do that because there are such things as quarterly returns. I mean, one of the consequences of that is if you look at the data from 2006, when there were about 7,000 stocks that traded on the New York Stock Exchange, that number has gradually gone down. Many other companies are choosing instead to be private companies and not trade in the public markets. Today we have roughly 3,000 companies. So approximately a massive decline of about 50% in just a few years, partly for what you've just described, which is this idea of short-termism and real concerns about the inability to deliver high outperformance in such a short span of time.
So as you describe yourself as an investor in the future, what do you need to see policymakers do to be able to claim the same?
Well, I think that the obvious one is infrastructure investment. I mean, whether you're in the United States or Canada, across the developed world, but also developing world, we need to see a significant investment in what is essentially the backbone of any economy. And I think this is something which is incredibly obvious to any traveler, that the world's infrastructure, particularly in developed markets, has deteriorated considerably. So if I'm an investor and I'm thinking about long-term prospects of putting money to work in an economy, even if it's in a different sector, the first thing I'd like to see is an improvement in the infrastructure.